Well, Tata Motors, that's the top loser today. All eyes on that stock after they reported very dismal Q3 numbers on all parameters. Surbhi's with us to run us through what brokerages are making of Tata Motors. Surbhi.
Hi guys, but I think the confusion out there is that do you really want to catch a falling knife, and who's going to be the first one to catch this one? It's been falling for a while, right? Anyway, let's get to some of the commentary that we've picked up, starting up first with CLSA. They're one of the big bears. They retain their sell holding or sell rating on the stock, and their target price is 150, which is pretty much where we are right now. They're talking about, of course, the weakness that we've seen in JLR margins, and they're saying that this could perhaps continue because there's more weakness seen in the China business as well as in the India business. So they have cut their EPS estimates by 2 to 66% over the course of the next 3 years up till FY21. And they say that there are insufficient near-term triggers to look at a buy at this point in time. Let's move to DB. Their target price slightly higher. They're looking at 175. They have a hold. But they also say that the operating environment is likely to remain challenging for Tata Motors. Again, there are EPS cuts that have come in, 38% for the current year, FY19, and 10% for FY20. Let me move to Axis Capital. Now, they're a little more sanguine. Here, the price target moves a little higher, 187. It is a hold rating on the stock that Axis Capital has. And they're alluding to the fact that, yes, JLR margins were a whole 200 basis points lower than their own estimates. But they're also saying that the P&L seems to be near a trough. It's a question of when do you want to get in and start buying. For them, they're saying we will get constructive once we see stability in volumes in China and once a lot of the Brexit concerns are behind the company. Last but not the least, Nomura is also at 187 in terms of the target price. They have downgraded the stock to a neutral, however. They're saying that free cash flow generation is a big concern for JLR, and this could take almost 2 years before things start normalizing on the cash flow front. They're saying that destocking could continue even in the next quarter, so watch out for margins. In fact, on JLR, they have trimmed their expectation on EBIT margins to a negative 0.3% for this year, FY19, going up to just 3.6% in FY21. They also say China and Brexit are the big concerns right now, so the overhang continues on the stock. Back to you.
Let's hear out what the management has to say. PB Balaji, the group CFO.
Jaguar Land Rover, the performance was impacted by corrective actions that we have taken in China, the weak market conditions there, and the production shutdown there. The revenue at 6.2 billion was down 1.4%, and PAT at minus 3.1 billion pounds basically got impacted by the corrective actions that we did on taking an impairment on our assets there. Taken a one-time exceptional charge for asset impairment. This reduces the growth and depreciation and amortization rates by almost 300 million per annum going forward. So it's a right step that we have taken in terms of reducing our costs, improving our break-evens, and as well as ensuring our competitiveness.
Well, let's move on and talk about some earnings. IGL came out with the numbers yesterday, largely in line with estimates. While the revenue and profit both managed to meet estimates, the margins were under pressure on account of higher costs. It was the double-digit volume growth that we saw, which the street had liked. E.S. Ranganathan, the MD of IGL, joined us on the phone line to discuss the details. Mr. Ranganathan, thanks so much for joining in. You have been able to maintain a double-digit growth in Q3 FY19. What growth rate do you expect to end the year with? And will you be able to see this high teens kind of volume growth even in FY20?
Yeah, we have been always maintaining that the achieving double-digit growth. So I also expect this year also we should be about 11, somewhere around 11%. And with Gurgaon coming, we should be increasing another 0.1 million to our this one, because we are already supplying 0.25 to them. And with aggressive expansion there in Gurgaon, we will achieve the next year's growth mostly from Gurgaon.
Okay, Mr. Ranganathan, you say that margins have been under pressure due to higher operating costs. What's the raw material cost outlook? And in that context, give us a margin outlook as well.
No, margin will remain the same. We have been following the cost-plus policy all through. And we were able to pass on all the cost increases to the customer because of the large differential gap in the diesel and petrol prices. So we should be maintaining this margin.
Okay, what's the outlook then on pricing? Is there a possibility that going ahead we could see some price hikes?
Yeah, depends on the price. If it goes up or down, we will accordingly switch on to the customer. Then there is always the US dollar has also stabilized now. It was very volatile before. So since all the APM price and the LNG price are pegged at the dollar, so the rupee exchange rate will also play a big part on the pricing.
Well, OMC has recently hiked trade commission on the stations. Is there an expectation of further hike of such commissions by OMCs?
Yeah, we should be looking at 5 to 8% increase every year because of the inflation and the cost incurred by them, the basic wages as well as land cost, land rentals.
Okay, so if you think they will increase the trade commission, sir, will you focus more on dealer-owned, dealer-operated kind of a model, or will you stick to the partnership with oil marketing companies?
We are going ahead with both, but the Dodo dealer-owned model is something which has been recently launched, so you can find more stations coming on that. Whereas in the OMC area, we have already, 279 stations. So the remaining stations are less in number, so there will be less coming as a new station.
All right, Mr. Ranganathan, the 10th CGD bid rounds have been completed. Wanted to understand, have you bid in this round, and what is the capex expectation for this particular round?
We have bid for 15 geographical areas, so we hope to land at least 3 or 4. So that will be adding our capex requirement of at least 3 to 5,000 crores in the next 8 years.
Okay, and will you fund this investment through debt?
No, our internal accruals are enough to take care in the next near future.
Thank you, Mr. Ranganathan, for joining in. So that's IGL saying that they will maintain margins. They will look to do a volume growth of close to about 11%, and they have bid for 15 geographical areas in the 10th CGD bid, that's city gas distribution bids, and they will be funding all this capex through internal accrual.